Gold is sitting at over $4,000 an ounce. Silver just crossed 67. And the most sober, most credentialed, most conservative monetary economists on the planet are quietly using a word they have never used before. That word is inevitable. The weight of the unthinkable. There is a word circulating right now in the quieter corridors of monetary power. Not in the press releases, not in the carefully managed quarterly statements that institutional economists craft for public consumption, not in the rehearsed testimony before legislative committees where every syllable is pre-approved by communications departments. The word is circulating in the marginal notes of research papers written for audiences of central bankers. It is in the footnotes that most readers skip. It is in the conversations held after the formal sessions end when the recorders are off and the title badges have been removed and the people who actually understand the machinery of global finance speak to each other with the honesty that professional survival rarely permits in public. The word is unthinkable, and what they are calling unthinkable with a mixture of reluctant awe and barely concealed alarm is the possibility that gold and silver, the metals that the modern financial establishment spent 5 decades systematically marginalizing, underweighting, and institutionally dismissing, are standing at the threshold of a revaluation so sweeping, so structurally total that it would reorganize the hierarchy of the entire modern financial world. They are calling it unthinkable. And history, which keeps better records than any of us and carries considerably more patience than the markets, has a very specific answer for the people who call inevitable things unthinkable. History says, watch. Before we go any further, I want to spend a moment with that word because I think it is one of the most important words in the vocabulary of genuine financial transformation. Every truly significant shift in the monetary order, every revaluation, every paradigm collapsed, every moment when the foundations moved and a new reality settled into place was called unthinkable by precisely the people who had built their careers, their reputations, and their mathematical models on the assumption that the existing order was permanent. It was unthinkable that the British pound would surrender its role as the world's reserve currency. Then it did. It was unthinkable that the United States would simply walk away from its international gold obligations abruptly, unilaterally, without warning. Then on the evening of August 15, 1971 on television and did exactly that. It was unthinkable that the largest, most venerable investment banks in the world, institutions with 150 years of history, and the full confidence of global capital markets could fail in the span of a few weeks. Then September of 2008 arrived, and several of them did precisely that, while others came within hours of the same fate. The word unthinkable is not a description of what cannot happen. It is a description of what the people with the most to lose from a particular outcome most desperately need to believe cannot happen. And it is therefore, if you understand how to read it correctly, one of the most reliable leading indicators available to the investor who is paying genuinely honest attention. What is about to happen to gold and silver is unthinkable to the people who constructed their intellectual lives on the assumption that the post-1971 fiat currency system, the dollar, dominated global reserve architecture, the debt-fueled expansion that has been running continuously and with increasing velocity since Nixon closed the gold window, is a permanent feature of the landscape rather than a historical episode with a beginning and therefore an end. Those people are not foolish. They are not dishonest. They are simply, and this is perhaps the most tragic version of being wrong to invest it in the world as it exists, to see clearly the world as it is becoming. You are watching this, which means you are not in that position. And that difference, the difference between seeing clearly and seeing what institutional comfort requires you to see, is about to matter more than it has mattered at any point in the last 50 years. Let me take you to a conversation in a quiet office in Zurich, Switzerland in the early years of the century. A conversation that, had it been widely reported at the time, would have seemed eccentric at best and mildly alarmist at worst, but that now viewed from where we stand in June of 2026 describes with almost uncomfortable precision the world we are actually living in. The conversation was between two economists, one of them a former official at the Bank for International Settlements, the institution that functions as the central bank of central banks, the apex of the global monetary hierarchy. The other, a private researcher who had spent more than 2 decades studying the long cycles of monetary history, with the patient, unglamorous discipline that most people in finance lacked the temperament to sustain. What they discussed in that quiet office over what I imagine were 2 cups of very good Swiss coffee was a scenario that both of them agreed was not merely possible, but on the basis of the historical patterns they had spent their careers mapping essentially inevitable, a moment when the accumulated contradictions of the post-1971 experiment, the debt, the monetary expansion, the systematic suppression of interest rates, the growing and increasingly grotesque disconnect between financial claims and real productive capacity, reached a breaking point from which the only exits were either a deflationary collapse of historic magnitude or an inflationary revaluation of real assets that would leave precious metals at the center of whatever monetary order emerged from the wreckage. Neither of those men published that conversation. It remained in the category of things that serious people understand but prudent people do not say aloud. But in the 20 years since, the conditions they described have not eased. They have not been managed away by clever policy or resolved by the natural corrective mechanisms of a functioning market. They have intensified. The debt has grown to levels that would have seemed like satire to any economist trained before. The monetary expansion that followed 2008 and then exploded again in 2020 went beyond anything those two men had modeled. The suppression of interest rates reached levels, actual negative real rates, across much of the developed world. That would have seemed like science fiction in any economics classroom before the turn of the century. And now in the middle of 2026, the contradictions they identified are not approaching a breaking point. They are at one. Here's what that looks like in actual numbers. Because this is a conversation that deserves data, not just atmosphere. Gold is trading at approximately $42,200 per ounce as we record this, up more than 23% from a year ago. Silver is trading near $67 per ounce, having risen over 84% in the last 12 months alone. Those are not the numbers of a quiet market. Those are the numbers of a market in the early stages of a structural repricing. And yet, and this is the part that should hold your attention, the analysts who understand the full picture are not saying the move is over. They are saying with increasing conviction and decreasing willingness to be privately diplomatic about it that it has barely begun. JP Morgan has published a price target for gold of $6,300 by the end of this year. Deutsche Bank is at $6,000. UBS and Societe Generale are at $6,200 and $6,000 respectively. These are not the projections of fringe analysts operating outside the mainstream. These are the house views of the largest and most carefully credentialed financial institutions on the planet. When JP Morgan and Deutsche Bank are calling for gold to approach double its current price within months, the word unthinkable has quietly left the building. But I want you to understand something that the price targets alone do not capture. The forces that are driving this are not temporary. They are not the product of a particular geopolitical moment or a short-term imbalance in supply and demand that will self-correct when conditions normalize. What we are witnessing is the convergence of multiple structural forces, each of them substantial on its own, each of them accelerating and each of them pointing in the same direction, and the investor who understands why not just what is positioned very differently from the investor who merely observes the price movement and tries to time the trade. The first of these structural forces is central bank behavior, and it is worth spending some time here because the data is extraordinary and its implications have not yet been fully absorbed by the broader investment community. Central banks around the world added over 1,100 tons of gold to their reserves in 2025. That was the third consecutive year above 1,000 tons. And it extended what is now recognized as the strongest sovereign gold accumulation cycle since 19. In the first quarter of 2026 alone, central banks purchased 244 additional tons, running above the 5-year quarterly average, even as the price continued to rise. Let me put that in perspective for you. Sovereign buyers are not price sensitive in the normal sense. They are buying gold as policy, not as a trade. They are buying it because the lesson delivered in February of 2022 when the United States and its allies froze approximately $300 billion in Russian central bank assets overnight is a lesson that every monetary authority on earth absorbed immediately and has been acting on ever since. The message was unmistakable. Dollar-dominated reserves can be weaponized. They can disappear at the stroke of a political decision. Gold cannot be frozen. Gold cannot be sanctioned. Gold does not belong to any government and cannot be confiscated by any other government's choice. For nations navigating a world of rising geopolitical friction and multipolar competition, that property, call it monetary sovereignty, has become not a preference but a necessity. 68% of central banks surveyed by the World Gold Council in early 2026 said they plan to increase gold holdings further this year. BRICS plus nations now hold 17.4% of global gold reserves, up from just 11.2%, 2% in 20. And in a development that deserves far more attention than it has received, central bank gold reserves have for the first time exceeded foreign holdings of U.S. Treasury bonds in total value, with official gold holdings reaching an estimated $5.2 trillion against $3.7 to $4 trillion in U.S. government bonds held by foreign monetary authorities. Gold has surpassed U.S. Treasuries as the world's preferred reserve asset. That is not a prediction, that is the reported present tense. And if you are wondering whether that matters, consider that the entire architectural logic of the post-97 system rested on the assumption that U.S. Treasury bonds were the unchallenged safe haven asset of global finance. That assumption is being retired quietly and without ceremony by the very institutions that once sustained it. If you are watching this and you feel the particular feeling of a person who has been right about something important for a long time and is now watching the world slowly, reluctantly catch up with what you already understood, I want you to hit that subscribe button right now, because what we are about to discuss in the second part of this conversation is going to deepen that understanding in ways that I believe will matter profoundly for every decision you make in the months ahead. The institutions are moving. The data is shifting. The thesis you have been holding is not fringe analysis, it is forward analysis, and we are just getting started. The confluence of forces. There is a concept in the study of economic history that deserves to be more widely understood. And I want to introduce it here before we go further, because it gives shape to everything else we are about to discuss. The concept is confluence, not a single cause producing a single effect. Not a linear chain of events where A leads to B and B produces C, but the simultaneous convergence of multiple independent forces, each of which would be significant on its own, all of them arriving at the same point at the same time and producing an outcome that none of them alone could generate. Monetary systems do not change because of a single cause. They change when enough forces converge at once that the existing order lacks the capacity to absorb them all. We are at such a moment, and the metals that are positioned to benefit from it are for reasons both ancient and remarkably contemporary: gold and silver. We have established the central bank dimension. Let us now add the dollar's structural challenge, because it is not separate from the central bank story. It is in fact the same story, viewed from a different angle. The dollarization of global trade is no longer a geopolitical theory or an academic projection. It is a measurable, documented, ongoing reality. The dollar share of global reserves has fallen approximately 14% since 2002, with a decline accelerating meaningfully after 20. Bilateral trade agreements conducted in non-dollar currencies are multiplying. Nations that once held U.S. Treasury bonds as their primary reserve are diversifying with increasing urgency, and the reason, as we noted in the first part of this conversation, is not abstract anti-American sentiment. It is the entirely rational calculation of sovereign institutions that have watched one government's foreign exchange reserves disappear in an afternoon and concluded that their own dollar-denominated reserves carry a risk that was not visible in the pre-2020 world. When the incentive to find an alternative becomes existential rather than merely economic, when the question shifts from should we diversify to what happens to us if we don't, the pace of diversification accelerates dramatically, and the alternative that every monetary system in history has ultimately returned to when the paper alternatives failed is gold, because gold is the only major reserve asset that does not carry a counterparty. The only asset that does not require you to trust another government's goodwill or another institution's solvency. The only monetary instrument that has maintained its essential character across 6,000 years of human commerce without the intervention of any political authority. Now I want to turn to silver, and I want to do it with the attention it deserves, because I think silver's specific situation in 2026 is actually more unusual and more potentially explosive than even gold's. And that is saying something. What makes silver distinctive right now is that it is being pulled simultaneously by two entirely separate sets of forces that are both accelerating and both structurally real. The first is the monetary force. Everything we've been discussing, the de-dollarization, the institutional reassessment of paper assets, the movement toward hard assets that cannot be manufactured by a central bank's decision. Silver participates in all of that. It always has. In every monetary crisis in history, silver moved in the same direction as gold, though often with more volatility and ultimately more magnitude. The second force is industrial demand, and this is where silver's situation becomes genuinely remarkable. The global transition to clean energy is not an environmental aspiration. It is one of the largest industrial mobilizations in recorded human history. The International Energy Agency has projected that meeting global climate targets will require the installation of solar capacity that is multiples of anything installed to date. Every solar panel requires silver not as a luxury component that can be engineered out at sufficient cost pressure. Silver is embedded in the photovoltaic cells that make the conversion of sunlight to electricity possible at the efficiencies that modern panels achieve. It is in the electrical contacts, it is in the components that nobody outside the industry talks about, but without which the panels simply do not function. At the same time, the global electric vehicle fleet is expanding at a pace that requires silver in quantities that supply chain analysts are only beginning to fully reckon with. Every EV contains more silver than the internal combustion vehicle it replaces. Medical technology, advanced semiconductor manufacturing, the 5G infrastructure being built simultaneously across dozens of countries, water purification and industrial scale. Each of these demand streams is real, each of them is growing, and they compound on each other in ways that make the aggregate demand picture for silver unlike anything the market has priced. The supply side of this picture is not keeping pace. Silver mining is not expanding at anywhere near the rate required to meet the combined monetary and industrial demand. The Silver Institute has documented a structural supply deficit in the physical silver market that has now run for 6 consecutive years as of 20. Not a temporary imbalance, not a one-year anomaly that a higher price will quickly correct, a persistent deepening, structural deficit that reflects the fundamental mismatch between a world that is consuming silver at accelerating rates and a mining industry that has not made the capital investments necessary to materially expand production. When a market has a structural supply deficit and an accelerating demand picture, the price adjustment is not a question of if, it is a question of when and of how large. And the honest answer based on the data we have is that the when is now and the how large is larger than current. Prices reflect silver has risen over 84% in the last 12 months as of this recording. That sounds like a lot until you consider that silver began the year 2026 near $71, reached as high as $115 per ounce in January, and has since pulled back to approximately $67. The volatility is real. Silver's character has always included volatility, and anyone who holds it needs to understand and accept that character. But the structural story, the deficit, the industrial demand, the monetary participation has not changed. If anything, it has deepened. The pullback from January's highs is not the end of the story. For the investor with the appropriate time horizon, it may be among the most significant buying opportunities of the decade. I want to introduce a name here that I think deserves more attention than the mainstream financial press has generally given it, because this person's argument, which was considered eccentric for most of her professional career, is now being treated with a seriousness in serious rooms that it was denied for decades. The name is Judy Shelton. She was nominated to the Federal Reserve Board of Governors. She is a senior fellow at institutions of genuine economic research, and she has spent her career making a single, consistent, deeply unfashionable argument. The world functions better with a monetary anchor that the 50-plus year experiment of pure fiat currency money backed by nothing but governmental assertion and institutional inertia has produced exactly the pathologies its critics predicted. Chronic inflation, asset price bubbles that inflate and then devastate ordinary people's savings, growing wealth inequality driven by the structural advantage that monetary expansion gives to those who hold assets over those who hold labor, and ultimately a level of sovereign debt that is in any honest accounting mathematically irrepayable in real terms. For most of her career, that argument was treated as the economic equivalent of advocating for a return to horse-drawn transportation, interesting as historical perspective, irrelevant as policy. But the conversation about monetary reform, about what comes after the current system reaches its structural limits is no longer confined to Austrian economists and gold standard advocates. It is happening in academic journals. It is happening in the hallways of central banks and finance ministries, not loudly, not with press releases, but unmistakably among the people who understand what the mathematics of the current trajectory ultimately requires. Consider the arithmetic of the United States government's current fiscal position. U.S. federal debt has surpassed $36 trillion. Interest payments on that debt now exceed what the government spends on any single department. When you add the unfunded liabilities of Social Security, Medicare, and other long-term obligations, the figure reaches levels that make the unbalanced sheet debt look like the manageable part of an unmanageable whole. There is no combination of growth, taxation, and modest inflation that resolves this in real terms. The only paths forward involve either an explicit restructuring, which would be called a default, or an implicit one, which is what sustained inflation above the interest rate on the debt achieves over time. In either scenario, the people who hold paper claims on the system, cash bonds, dollar-dominated savings, bear the cost of the resolution. The people who hold real assets that exist outside the paper system, physical gold, physical silver, are differently positioned, not necessarily immune to disruption. Nothing is immune to disruption, but differently positioned outside the pressure cooker rather than inside it. And in every historical instance of this type of monetary stress resolution, that difference has been consequential. Here's what I want you to carry into the third part of this conversation. The forces driving gold and silver higher are not temporary. They are not the product of a single geopolitical event that will resolve and return conditions to the pre-2022 baseline. They are structural, they are mathematical, they are the product of 50 years of accumulated monetary decisions that cannot be unwound without cost. And the cost when it arrives will be borne in the currency of purchasing power. The people who understand that and have positioned accordingly are not making a speculative bet on a particular price level. They are making a structural observation about the relationship between paper and real assets in a world where the paper system is reaching the limits of its capacity to sustain itself. That observation has been confirmed in the first half of 2026 by the most tangible and least deniable form of evidence available: the behavior of central banks, which are the most sophisticated and most consequence-sensitive institutional actors in the global financial system. When those institutions are buying gold at the strongest pace since 1967, they're not making an emotional decision, they are making an institutional one. They are telling you in the only language that institutional actors speak with complete honesty, which is the language of portfolio allocation, exactly what they think is coming. And if you are still watching this, you already know what they are saying. The dawn before the day. There is a specific quality that characterizes the investor who has done genuine work on a thesis rather than simply absorbed a narrative. It is the quality of being unruled, not complacent, unrattled. The investor who has done the work understands why prices move in the ways they move. They understand that volatility is not a reputation of a structural thesis. They understand that the path between the current price and the eventual price of a correctly identified structural opportunity is never a straight line, and that the disruptions along the path are not evidence against the thesis. They are in fact the mechanism by which the thesis ultimately delivers its returns. Only those who sell at the disruptions fail to collect the outcome they correctly identified. I want to talk about that quality now. The quality of being properly positioned and genuinely prepared, because I think it is the most practically important thing this conversation can offer. Let me give you 4 specific actions grounded in what we have discussed that every person who takes this conversation seriously should undertake in the days and weeks ahead, not in the abstract future. Now, the first is what I would call the honest portfolio audit. Take a literal piece of paper, not a spreadsheet paper, and write down every significant asset you hold. In the column next to each one, write what happens to its real value in a scenario of sustained monetary stress, significant dollar devaluation, inflation that runs persistently above the yield on your fixed income positions, a meaningful loss of institutional confidence in paper instruments. Then write in a third column what happens in a scenario of monetary stabilization, rates normalized, debt addressed through some combination of growth and modest restructuring, the current system restored to something resembling functional equilibrium. When you complete that exercise honestly, you will find that your precious metals holdings are in all likelihood the only assets in your portfolio that appreciate meaningfully in the stress scenario while maintaining reasonable real value in the stabilization scenario. That asymmetry, limited downside in the better scenario, significant upside in the more challenging one is the definition of a genuinely valuable portfolio component. And seeing it in your own handwriting about your own specific situation has a clarifying power that reading someone else's thesis cannot replicate. The second action is to assess your allocation relative to what serious analysts describe as a meaningful protective position, the range that consistently appears in the work of credentialed monetary analysts is 15 to 25% of total net worth held in physical gold and silver combined. If you are significantly below that range, you have an allocation gap. The analysis we have been building today, the central bank behavior, the de-dollarization, the silver supply deficit now in its 6th consecutive year, the debt arithmetic of the major Western economies, all of it suggests that closing that gap at current prices before the structural forces we have described produce the repricing that the data implies is coming is among the most important financial actions available to you right now. Not all at once if that is not financially prudent, but deliberately with a clear timeline and a commitment that you treat as non-negotiable. The third action is to diversify within your precious metals position. Gold provides the monetary stability and institutional recognition. It is the metal that central banks hold that governments reach for in monetary resets that tends to move first and most reliably in any scenario involving a loss of confidence in the paper system. Silver provides both monetary participation and the industrial demand upside that gold does not offer. It is the metal that exists at the intersection of the monetary and the industrial worlds simultaneously, which means it has two engines of demand rather than one. The specific ratio between them is a personal decision that depends on your risk tolerance, your time horizon, and your conviction about the relative timing of each metal's move. But both belong in a complete precious metal strategy. The person who holds only gold is missing the industrial demand story that may ultimately drive silver's repricing more dramatically than gold's. The person who holds only silver is exposed to more volatility than the person who holds the combination. The fourth action is the one I want to spend the most time on because I think it is both the most urgent and the most frequently deferred. It is the physical versus paper question. If your exposure to precious metals exists primarily through ETFs, futures contracts, or pooled accounts, you do not fully own what you think you own. You own a claim on metal, you own a contractual relationship with a counterparty institution that holds or is supposed to hold the underlying metal on your behalf. In normal market conditions, the practical difference between owning the claim and owning the metal is small. In the conditions of genuine monetary stress, the conditions we have been discussing for the last 45 minutes, that difference becomes the entire question. The assets that protect you in a scenario of systemic stress are the assets that are not themselves inside the system that is under stress, physical gold and silver that you personally control, stored in a manner that does not depend on the continued functioning of any financial institution, are the only version of precious metals ownership that fully delivers on the promise of hard asset protection in the scenarios that require hard asset protection most. Everything else is a partial solution, and partial solutions in scenarios that require full protection are where people discover too late that they were not as prepared as they believed. Now, I want to speak directly to the person who has been holding this thesis for a while, the person who began accumulating gold and silver when the price was lower, when the thesis was less visible, when the conventional financial world seemed to be providing daily evidence that the entire idea was misguided. You held through that period. You held through the skepticism of people you respect. You held through the volatility through the months when the price went sideways or down while everything else seemed to rise without effort. And now the world is slowly and then less slowly arriving at the position you've been standing in. The central banks are confirming your thesis with their buying. The price data is confirming it with its trajectory. The institutional forecast from JP Morgan and Deutsche Bank and the rest are confirming it in the language that the mainstream financial world speaks most fluently. price targets, and portfolio allocations. The vindication is warranted, but the responsibility that accompanies it is equally real. The responsibility to ensure that your position is as complete and as well structured as the opportunity now demands. To think carefully about the people in your life, family members, friends, people you care about who are carrying the full weight of paper exposure in a world where the case for hard assets has rarely been more structurally compelling. And to consider what honest, low-pressure, genuinely caring role you might play in offering them the same quality of thinking that you found your way to. Not alarm, not pressure, not the self-satisfaction of being right in a way that requires the suffering of others to confirm. Simply the honest offer of serious information to people you care about with full respect for their right to make their own decisions with their own money. Let me close with an image because I think it is precisely accurate rather than merely convenient. There is a specific quality of light that exists in the minutes before the sun fully clears the horizon. It is already real, it is already illuminating the world, but it is not yet the light of full day. And most people still inside, still behind their windows, have not yet noticed it. The people who are outside in those minutes, the people who are awake and paying attention, experience something genuinely rare. They see the world before most people see it. They have the light before the day becomes crowded with the noise of 1,000 competing voices, all announcing what was already obvious to the people who were outside first. We are in that quality of light right now with gold and silver. The dawn is real. The light is already coming. It is in the central bank purchase data. It is in the 6 consecutive years of silver supply deficit. It is in the de-dollarization numbers, the 14% decline in the dollar's reserve share since 2002. The fact that gold has now overtaken U.S. Treasury bonds as the world's largest reserve asset. It is in the mathematical impossibility of the current debt trajectory sustaining itself indefinitely without some form of resolution that advantages real assets over paper ones. The light is real and it is already present. What is still in the future is the moment when the rest of the world, the part that is still inside, still behind the windows, opens its eyes and sees it. That window, the window between the real dawn and the moment of general recognition, is precious, it is finite, it will close. The investor who uses it, who positions completely and thoughtfully and without the panic that hasty decisions introduce, who builds their structure now while the crowd is still assembling its thoughts about what is happening, will find themselves in the months and years ahead holding what they built before it became obvious that they should have. That is not a comfortable feeling in the accumulation phase. It is an extraordinary feeling in retrospect. In retrospect, arrives faster than almost anyone ever expects it to. Get positioned, get structured, get ready, and then hold what you have built with the confidence of a person who understood something true before it became the consensus, because the unthinkable is not unthinkable to you. You have thought it, you have acted on it, and the world is beginning slowly and then all at once to agree with you. Before you go, I want to ask something of you. Not as a closing routine, but as a genuine request. If this conversation gave you something real, a sharper framework, a more complete picture, a piece of the puzzle you had been missing, then leave a comment below right now and tell me what resonated most. Tell me where you are in your own precious metals journey. Tell me what questions this raised that you want me to address in a future conversation. Every comment you leave becomes part of the research for what we build. Next, your question might be the question that shapes the next video that reaches someone who needs it exactly when they need it. That is a real and meaningful thing, and I am asking you for it genuinely. Subscribe because this monetary story is not finished. It is accelerating the specific events, the policy decisions, the central bank disclosures, the market movements, the data releases that will shape the trajectory of gold and silver in the months ahead. I will continue to cover all of it with the same honesty, depth, and respect for your intelligence that this conversation has reflected. The people who are subscribed will be the people who are informed in the environment we are moving into. That distinction will matter. And share this with one person, not everyone. The person whose financial security you care about most, who has not yet had this conversation, not to alarm them, not to recruit them to a position, just to offer them the honest, grounded, serious thinking that you found here, and trust them to make their own decisions with better information than they had before. The dawn is real. You are already outside in it. Stay there. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk tolerance. Do your own research. Consult qualified professionals for your specific situation.